What Nigerian net worth brackets actually look like and what they mean. Most conversations about wealth and net worth in Nigeria get stuck on income. Salary comparisons, naira devaluations, the cost of living in Lagos versus everywhere else. But net worth, what you own minus what you owe, tells a different story. And most people have no idea where they actually sit. Before the numbers, net worth isn't your salary, your job title, or your monthly balance before rent hits. It's your total assets, cash, investments, property equity, vehicles, any business stake, minus your total liabilities, loans, credit card debt, what you still owe on that car. Everything in, everything out. The result is your actual financial position. It's also worth noting that these figures typically reflect households, not individuals. Two incomes, shared expenses, combined assets. Keep that in mind when you are placing yourself in the picture. The middle, where most people are. The median tells you what the person exactly in the middle of the distribution holds. In Nigeria's context, most households at this level have some combination of a few months' cash savings, a small amount in a pension fund they haven't fully thought about, a vehicle that's worth less than what's still owed on it, and possibly some equity in land or property, often inherited, not acquired. Debt at this level tends to be persistent. Consumer credit, informal borrowing, and the constant pressure of high inflation eroding whatever was saved last year. Net worth at the median isn't nothing, but it's fragile. One health emergency, one job loss, one major repair, and the number moves fast in the wrong direction. Above average, stability starts here. Moving meaningfully above the median, the structure begins to shift. This is the point where some assets start to hold or grow in value rather than just sitting still while inflation works against them. Home equity becomes more significant, not because property is necessarily a great investment in every market, but because owning property outright or being far along in paying it off removes a major monthly liability and builds a real stake. At this level, people tend to have some retirement savings with actual compounding behind it, possibly a business with tangible value, and at least a modest investment portfolio. The financial anxiety doesn't disappear, but there's more cushion. An unexpected expense doesn't automatically become a crisis. The important nuance is a lot of this net worth may be tied up and illiquid. Land that can't quickly be sold, pension funds that can't be accessed for years, a business that has value on paper but no easy exit. The number looks strong. The cash position might tell a different story. Genuinely comfortable when assets start working. There's a threshold where wealth stops being mostly about what you put in every month and starts being more about what you've already built. This is it. At this level, invested assets, market positions, diversified portfolios, income-generating property, established business equity make up a meaningfully larger share of total net worth, and that changes the dynamic entirely. When your money is working alongside you rather than just sitting in defense, growth becomes less dependent on your monthly savings rate and more dependent on what you've already accumulated. A household at this point in Nigeria might hold significant real estate, multiple properties, at least one generating rental income, combined with equity in a business, a solid pension position, and some exposure to dollar-denominated assets as a hedge against naira volatility. That last point matters more here than in most financial conversations written for Western audiences. Optionality also expands. Career decisions become less purely financial. The ability to take a sabbatical, change industries, or invest in a new venture without existential risk, that flexibility is one of the real markers of having crossed this threshold. Genuinely wealthy, a different set of rules. Above this is a tier where compounding becomes so powerful that the math starts to feel almost abstract. A large invested portfolio growing at historical market rates adds more wealth in a single year than most Nigerian households earn in total income. And it does this without a single new contribution. That's not a commentary on fairness, it's just how compounding works at scale and why this tier is so hard to enter through income alone. The people who reach it almost always have some combination of decades of high savings discipline, business ownership or exit at the right time, significant real estate accumulation, inherited land or wealth, dollar-denominated assets that held value through repeated devaluations, or some convergence of all of these. It's also disproportionately older. What looks like a wealthy 60-year-old often represents 30 years of decisions, some brilliant, some just consistent, that ran quietly in the background. The wealth didn't appear, it accumulated. What the number actually tells you. Two households with identical net worth figures can be in completely different financial positions, depending on how that wealth is structured. A household with most of its net worth in an illiquid ancestral property they can't sell, a car losing value, and no invested assets is in a fundamentally different position from one where the same total is split across index funds, a rental property with positive cash flow, and a working emergency reserve, even if the numbers match on a spreadsheet. In Nigeria specifically, the composition of net worth carries extra weight. Assets denominated in naira depreciate in dollar terms with every currency slide. Property in some areas hold value, in others the market is thin and selling takes years. Pension access is delayed and often poorly managed. The formal investment infrastructure most people in Western personal finance content take for granted simply doesn't exist in the same form here. So the real question isn't just what your net worth is, it's what your net worth is made of. How much of it is liquid, how much is growing, how much is actually protected against the specific economic conditions you're operating in. Break it down. The total is just the starting point. Understanding where you are is not about comparison. It's about clarity. Once you see your position clearly, you can make better decisions about where to go next. Subscribe for more honest conversations about money in Nigeria.